Good afternoon, everyone. Welcome to IAB Europe's State of the Nation webinar. We'll just give it a few moments just to let everyone connect, and then we will shortly kick off. Okay, I can see lots and lots of people entering the webinar, so let's go for it. So yes, welcome to IAB Europe's State of the Nation webinar. My name is Helen Muzzard, and I am the CMO for IAB Europe. I'm delighted to be your host today and kick off our Q4 edition of this particular webinar. They are presented by Daniel Knapp, the Chief Economist for IAB Europe, and they're designed to share the latest outlook for the digital advertising industry. I think we've probably got many people that joined our last update in October, where Daniel shared his growth predictions for 2023. So today he's going to be providing an update for that, and in particular looking at the channels he believes will drive some of that growth. It'll be interesting to find out if we have got much movement from last time. The last couple of webinars, every time we've looked at growth, Daniel has slightly downgraded the percentage. So if we are sticking with what was true in October, it looks to be quite an optimistic year. Okay, so with that, I'm going to hand over to Daniel. Because we're live today, I would say that we really do encourage questions from the audience. So if you do have any questions, please put them into the Q&A box, and I will pose those to Daniel at the very end. You're more than welcome to be anonymous, or you can put your name as well. Okay, thank you so much.
Wonderful.
Hi, Daniel.
And hello, everybody. This marks our end-of-year outlook for digital advertising in Europe. We all know that we are in the poly crisis. This is the theme we established for this unique concoction of macroeconomic conditions that we're in. A term, as I mentioned, popularized by Adam Tooze, the economic historian. The poly crisis means that we have several crises happening in parallel, which are both co-constituting each other and also amplifying each other, with us as businesses and societies lacking clear recipes to tackle them either individually or, and most importantly, in interaction with each other. And we all know from our past webinars that digital advertising is facing a poly crisis in a sense, both in terms of the cyclical economic issues, then also we have the structural formation, a transformation of the entire industry towards a post-third-party cookie world, with signal loss and new solutions being developed at the very same time. So it's a multidimensional issue that we have. And today I really wanted to focus on the ad spend numbers, as since our last forecast, also the larger agency groups have released their end-of-year forecast. So we want to see, has there been any movement in the data? What do we think of the agency forecast? Are we more optimistic, more pessimistic? And a little outlook into some of the main growth areas. After that, we will open for discussions. There are, of course, many other trends we could think about. And in January, we'll discuss a 2023 top 10 trends outlook, which will go beyond ad spend itself and speak also about other things, like, for instance, the rise of, the amplification of marketing, for instance, with Amazon's new clean room solution, and other things which are not suitable to conveying in an economic forecast model, but are more kind of qual-quant trends combined together. But for the end of the year, let's focus on the statistics, and let's say with what numbers are we closing out the year, and what can we expect for 2023 to have in stock for us, just in terms of pure ad spend growth numbers. To recap, it's pretty clear that the tightening economic situation in 2022 was a forebearer to a rougher ride in 2023. The IMF forecasts clearly illustrate this. If we look at, for instance, also at the recent EU forecast output, they are expecting a flat growth for the next year, whereas, for instance, Goldman Sachs is expecting the Eurozone to face a long-term 2 to 3 percentage point overall decline in GDP. What we can see here is that the UK is faring worse than the European Union due to the combined effect of Brexit, the Liz Truss experiment, and other factors, the EU faring worse than the world, and also worse than the US, as some of the global trends that we're seeing are because amplify and have a stronger impact in the EU, and with other factors, of course, in particular due to the physical proximity of the Ukraine, energy policy in Germany, and other things which are impacting the situation. If we look at, let's go back here. Oops. If we look at what's happening, we can see in situations like these, we typically get ad recessions. Here we can see a historic view of ad spend growth since the beginning of the millennium. And in Europe, we had in that time 4 ad spend recessions. We had the dot-com crash, the financial crisis, or the Lehman moment, actually an 08 moment, only really happening in 09. We can see the Eurozone crisis contained to fewer countries, meaning here decline was lower as the strong market of the UK could in a sense counterbalance that. And then we had COVID-19 as well, and we all know it went pretty well for digital advertising, which did not decline, but grew by over 6%. But the overall media market, if we look at agency data, declined by around 8%. So again, here we saw the correlation with overall economic growth continue throughout these different ad recessions, despite the fact that in digital, we saw a decoupling of that in 2021. I think it's remarkable that we saw this extremely strong rebound after COVID-19, a stronger rebound in terms of magnitude than the decline. So it was a very quick, a very sharp recovery. If you look at Lehman, a financial crisis, for instance, we saw that it took a few years to come back to this kind of post 2008 moment. And the Eurozone crisis actually was served as a double whammy, which slowed down recovery. We saw some media markets, in particular in Eastern and in Southern Europe, only reaching back at kind of pre-Lehman levels at around the 2016, 2017 time. The question is, when we look at these past recessions, is there something that we can learn from those for the particular moment post-2021 that we find ourselves in? I think it's remarkable, in particular, when we look at the financial crisis, Lehman. That was an event that happened in 08, and we thought, and we saw, of course, it shaved off growth in 08, but the real impact only was in 2009. In a similar way, we saw COVID, but in exactly the other way around, where the impact was immediate in terms of ad spend. But then even as the pandemic persisted, we saw growth already recovering. So in a sense, if we look at it, it was kind of the inverse reaction to the Lehman crisis. Right now, I think we are in a moment which is more similar to the 08-09 crisis, where we already know, in a sense, factors which impact growth, and there are factors which slow down the economy, which are not driving an immediate and sudden collapse. So here, we're going to see factors mounting in importance and continuing to slow things down. Like in 08, it wasn't as soon as we knew that something was going on, the entire market stopped. But the ad market only really hit in 09. So similarly, we know the economy is slowing down. We know consumer price inflation is up, but the real impact, we believe, is going to be expected in 2023. Spoiler alert, you will see some divergence between our assessment of the situation, particularly in Europe, versus the forecasts of the agency holding companies, which are painting a more optimistic picture. But some equity analysts are even more on the kind of cautious side than we are. So we are maintaining some middle ground, but we think that some forecasts out there might be too optimistic. We know that across European markets, ad markets amplify macroeconomic conditions. Let's go back to 09, the post-Lehman moment, which is, I think, the most interesting crisis for comparison, Eurozone was contained and COVID was its own very special beast. This was an economic crisis here in 2009. And we can see both nominal GDP growth in countries, and we can see all media advertising growth in those countries. And you can clearly see the amplification effect. Typically, we see sometimes the relationship is not entirely linear, but typically we have an amplification effect, an average of 2.5, 3x of advertising overreacting to a downturn in GDP. But we can already see that when it comes to nominal GDP, not real GDP, that the danger zone for advertising, advertising not growing anymore, starts already at around 3%. That was, of course, in pre-2002 times of inflation. And we found that historically, there's a 90% chance of an ad decline if nominal GDP is below 1.47%. We look back at up until the 1960s, and we lose some granularity and some historical data. So we need to do that on a smaller country sample base. Germany, France, the UK, we got, and also Italy and the US. So all things considered, with a weakening economy, it looks like it would look like that we're set for an ad recession. But beyond the broader kind of very, very macro picture, there are, as I mentioned during our last call, a couple of push and pull effects at play, which are persisting, which aren't entirely rooted in the economy, but which are relating to some over-exuberance from COVID times, and also, of course, the structural transformation of the advertising sector. We maintain that SME spending is reaching or has reached the ceiling. It's hard, as I mentioned in the previous call, to get a full view of what SME businesses are doing, but spot checks, a cursory analysis on some of the companies that do report, that put out commentaries on advertising, indicate that it's hard for many to just physically spend more, as customer acquisition, retention, etc. Post-COVID, when the e-commerce world is slowing down, is becoming much harder. It doesn't really work anymore. And these SMEs are around 70% of all digital ad spend in Europe. We have, and that's related, of course, the continuing issue of targeting signal loss, which leads to spend not necessarily just shifting to other channels, but in part also evaporating, in particular in the performance segment, in the gaming segment, in the e-com segment. But we can also see something else, where as we as the digital industry are still working to build viable solutions that are privacy compliant to mitigate targeting loss, we see some on the brand advertising side, so not on the performance side, small performance advertisers or even large performance advertisers. On the brand side, a slowing down of the migration of budgets from traditional media to digital media, as advertisers value contexts which they understand in terms of data leakage, data protection compliance, and so forth. And in particular, television, despite high CPMs, historically high CPMs, and also out of home have been benefactors of that. Also, no news, we see the continued correction of e-commerce growth overall. We see e-commerce forecasts have been revised downwards and downwards. We can see that from the Office of National Statistics in the US. We look at company reports like Zalando, we can see kind of flat GMV growth for the foreseeable period. And after this COVID-induced over exuberance, we see just a correction of the e-commerce spend, which is of course impacting digital ads as well. We see tech correction from growth at all costs to profitability has an impact on marketing expenditure as well. We're also seeing specific sectoral impacts right now coming in. Some are smaller, some are larger, some are hard to quantify. I think the crypto market implosion is interesting, with large spenders from Coinbase, Robinhood partially, Crypto.com, FTX, etc. Yeah, even has some impact, of course, on the Super Bowl, on Super Bowl spending, but also in particular in digital ads. Apart from the large kind of crypto companies which report marketing expenditure, and analyzing some programmatic spend on what comes from crypto spend, in SSP access that we have, for instance, from publishers. It's hard to say how big that market really is. We don't believe it's big enough to topple the digital ad market globally or to materially change the direction of a trend, but it's just one additional layer, one additional factor of putting the brakes on. We can also see the automotive supply chain is still disrupted, parts are missing. Auto was a huge advertiser digitally and beyond, and we think that this is still going to remain problematic in 23, although some agency groups are seeing further growth in automotive, which we can't see yet. Lastly, of course, look at the last mile delivery market, related, of course, to e-com. Now with Gorillas being acquired for equity, not for cash, I think it really shows there's some disruption going on in that market, and a lot of those businesses, of course, with consolidation going on here, is going to shrink ad spend. Of course, in Europe, we have the continued energy costs, inflation, Ukraine war, which is having a stronger impact on marketing budgets than elsewhere in the world. Apart from those negatives, though, we can see positives as well. I tried to put 6 positives towards the negatives. It was a bit harder to do that because some of the points of the negative side are already quite aggregated, and I really split them out minutely on the positive side. So take that with a grain of salt. Regardless, here's 6 points. We see, we're going to come to that in a second, an uneven distribution of cautiousness across advertiser sectors. Luxury is up, travel is up and expected to be up also in 23, entertainment sectors as well. We see and will continue to see through 23 net new money moving to digital, which hasn't happened for a while, particularly due to the digitization of trade budget and other things through the retail media avenue. This is new money overall in what's considered the ad market overall, not just digital. And we can see that at the very bottom here, some 0.5, specifically redistribution of linear traditional spend into digital is coming, despite the fact that there's some privacy concerns. We can see, and that's very important, an uneven impact on consumer price inflation for consumers themselves. There are groups of consumers which feel, despite an average evaporating savings as well after COVID, still are spending strongly, also in Europe, and we're going to come to that in a second. We can continue to see foreign APAC Chinese advertisers pumping money into Europe to sell their goods there as the domestic market is shifting. And we can also see not all markets in Europe are equally negatively affected. We see uneven exposure to macro factors within the European markets, which create a mixed bag of market trends across the countries that we do cover. And let's dive into some of those trends a little bit more. So I think one important thing is that we have a bit of a bad news situation when it comes to the global supply chains. What you can see here is an indicator we looked at earlier as well during COVID and the recovery. What does it cost to ship something from A to B? These are global container freight rates from Jan 2019 to October in dollars. We can see after the peak of the pandemic with the long queues at harbors, this is correcting. This is in a sense good news. It's becoming cheaper to ship stuff. So this creates favorable environment, for instance, of Chinese firms exporting to the US and Europe. But these freight costs are not coming down homogeneously across the world. In particular, European US routes are still more expensive, where we haven't seen such a decline. And also, it's not just an expression of congestion in the supply chain easing. We can also see, and there were recent CNBC reports of actually decreasing demand, i.e. less stuff being shipped due to weakening consumer demand. So this is a bit of a bad news, good news, bad news situation. I mentioned before consumer price inflation and that some consumer segments are continuing to spend. And this is the curse of averages. When we look at official statistical data from Eurostat, from the ONS, or wherever, we typically look at aggregate data across all strata of the population. When consumer price inflation is up, of course, we feel there is a concern, and that higher prices will lead to a slowdown in consumption and also a slowdown in ads. At the same time, when we are in global cities like London or Paris, we can see large queues in front of luxury shops. We can see consumers still spending on goods and services. And I think this analysis that the FT conducted earlier in the year really illustrates that we need to move away from averages to understand how macroeconomic factors impact advertising expenditure and also consumer behavior. On this chart, you can see disposable household income. They standardized the household size here to I think 2 people, depending on what percentile of the population you're in. And I think it's important to look, just for illustrative reasons here, at the UK. UK is the largest European ad market, yes, but also I think it's kind of very symptomatic, or it just exemplifies this argument that I want to make very well. We can see the 97th percentile is of household savings. It's very strong. It is kind of in line with or partly above the developed country average. The same is true kind of for the 19th percentile. But then if you move to lower percentiles from the 15th to the 10th to the 5th, you can see that things aren't looking that good anymore. Meaning within a society, you have different percentiles of the population who are differently affected by changes in inflation. And it means, though, also conversely, that we have small segments of the population which overall, due to their consumption habits, are holding up advertising markets more than averages in consumer price inflation would otherwise suggest. Another thing to consider, of course, when it comes to right sizing or profitability versus growth, is that the tech layoffs that we've seen, and they are kind of really changing. They're signaling a change both in terms of advertisers, how much they're going to spend, but, and we're going to come to that also, of course, provide a read through on structural changes of winners and losers in the digital ad market. There's a fantastic source called layoffs.fyi, which tracks layoffs across companies. And you can see in blue the employees being laid off here, and then you can see in a given time period and the number of companies with layoffs. And you can see both have been increasing rapidly during the last quarters. Yes, this also was the case in Q2 2020 when COVID really hit, but these were, if you drill into the data, very different kinds of companies. It was mostly travel-related tech companies, travel bookings, etc., construction tech, real estate, etc. So really things that were providing digital services within the physical economy. This is very different, as we all know, in the current environment. And these layoffs, of course, also mean much more conservative budgeting, so less, in a sense, whoppers available, to use Sir Martin Sorrell's parlance, or kind of constraints in terms of ad budgets coming from large tech companies. But of course, it also means a signal to the financial markets, cost correction, we are in control, etc. But of course, also it's an expression of what's going on in the ad market, and we're going to come to that. Now, if we look at some of the agency forecasts, and this is the latest Magna forecast, we can see that overall, in terms of all media, the top 5 European markets, they lag behind high growth countries. This already was the case in 2022, where the European big 5 are far behind other markets, developed markets like the US, South Korea, Australia, but clearly also the emerging large markets, which are going to become some of the largest ad markets globally: India, Brazil, and Indonesia. If we fast forward to 2023, we can see a following picture. This isn't our forecasts, but agency forecasts, as I said, we'll be a bit more pessimistic, but we like and agree with the direction of travel, what we are hearing from our own IAB Europe markets. Here, what we've done is we looked at the Magna Q2 and Magna Q3 forecast for 2023. And then we measured the magnitude of revisions and ranked this chart here by downward revision. The country with the highest downward revision on the left, and the country with the lowest downward revision or even highest upward revision on the right. And you can see a wide spread here from Germany to India, where countries between Germany and Canada have faced downward revisions, and other countries, in particular, particularly in APAC, have received an upward revision. And we can see that within our group of European countries, some of our largest markets here have actually seen the highest downward revisions. Germany and France, which together make up nearly around 40%, I think, of the total digital ad market. In terms of all media spent, here faced the highest downward revisions. The US remarkably also has faced a downward revision after still fairly strong growth and optimism in 22, but this we believe is mainly an expression of the lack of cyclical events and drivers in the US in 2023 after the World Cup and other sports events, because the US is highly susceptible to those things, much more so than European countries where sports events can actually be a net negative for advertising. The odd one out for me is the UK, where Magna, but also other agencies have maintained a fairly optimistic growth picture, despite the, if you recall earlier in my presentation, the IMF data for the UK, which was extremely weak, and also the kind of rampant consumer price inflation we have in this market. We think the overall European picture will really stand and fall with how well the UK will be doing, really. And we think the market might not be as strong. Of course, in here we just have the European Big Five. We see also sluggish performance likely in Eastern Europe, in particular in those countries in close proximity to the Ukraine war. But overall, this I think shows the direction of travel that we find ourselves in the markets, and we have maintained, not changed since our last outlook, overall slightly more pessimistic short-term outlook, which we believe reflects the poly crisis and the structural challenges in the market. So we're still expecting a 2.4% growth for overall digital and a decline for overall media. We're glad to stand corrected, but currently we are not able to see factors which would allow us to correct this. We will look at this on a quarterly basis, but it's better to be cautious. What we have done, however, assuming there's a broadly a pool of money available of a 2.4% growth, we've changed slightly how we are allocating this growth across different formats. We've maintained our retail media forecasts and actually believe here that retail media in Europe is going to grow faster than other regions. If I recall, the Group M forecast or Magna forecast on retail media was around plus 13% globally. We believe Europe, which is around 3 to 4 years behind the US, is growing more strongly than this, despite these headwinds. We've maintained that, but we have changed our growth expectations for search and video. For video, we have upgraded based on continued shift of budgets from TV to AVOD and the European, there's still very small CTV market. And we've also slightly downgraded search. There is a bit of data available in the market, I think from Standard Media Index, that is suggesting a decline in search. We are not able to substantiate that in our in spot checks with our channels, with agency partners, with other market participants, and see the 2009 perception of search being a safe bank in a volatile environment and highly technical to still prevail. Of course, the nature of search is changing, and in data that we have available, the separation between search and search-based or search associated with retail media is not always clear. We, for instance, believe that over 20% of Google search revenue is already coming through, I think, sponsored search results, sponsored product search that link back to retailer sites. Here, we in Europe need, with our ADEX study, I think other forecasts as well, get better at really drawing the line between those markets as much as it's possible. Bottom line is we've slightly downgraded search, but not substantially, and are still more optimistic at search than other commentators. What we have done, however, is we have further downgraded social, which in our October forecast stood at around 1% growth. We now believe that we're going to face around about 2% decline in the social market in Europe next year. We have not touched the other components of the forecasts, and this was kind of a rebalancing predominantly between social and search, which are the large contributors, as retail media isn't as big as those. But yeah, that I think shows our slightly changed picture, but we haven't changed course entirely at the macro level in terms of the direction of travel. Let's drill down a little bit into details. I think on the back of the social market, but also other things like a slight downward revision of search. I think it's interesting to look at company results, and I've just picked out 3 here and mapped them against the total digital ad market growth globally, excluding China. I took the Group M data for that. This is pure play digital, so I think some of the digital extensions of traditional media owners are not included here. Regardless, it's a remarkable picture where we can see companies that had historically outperformed the overall digital ad market now actually underperforming it or coming much closer to averages from a period of overperformance. Of course, when we look at Alphabet, we've got very different sections. Others were overperforming, others not. But this was really in the past an expression of the maturity of the business overall, whereas right now, post-COVID, we see it more of a, I think, expression of the overall kind of targeting signal and kind of macro weakness that is underpinning results overall. Company results are also a bellwether for more broadly shifting trends. So here we look at the Q3 results of a few companies. Total ad revenue from some large social and other players, and then we looked at the retail media divisions. As you all know, it's a key growth area that we identified, retail media, and looked at how revenues look there. And it's quite a different picture in the very same period, still illustrating we are both in a push and pull market with some headwinds, but also with opportunities of growth left, which are strategic opportunities. Overall, let's dive into this retail media market a little bit more. We've expanded our analysis and looked at where do specific European markets stand. So since October, we've broken out our modeling to incorporate all of the markets we're covering in our ADEX study. And I have added a few here just to show the maturity of that market. So what we can see is the US is outperforming. It is 3.1x kind of as mature if you overlay, if you do retail media as a share of the total e-commerce revenues generated in that market, where it's in the US, it's 4.7%, which is, in a sense, slightly below where Walmart is, and also we believe kind of broadly in line with where Amazon is. When we look at Germany, we can see the market 2.1% retail, a share of e-com, mainly driven by the dominance of Amazon in that market, but also a flurry of launches and large retailers like Otto, for instance, and others pushing in the market. In the UK, with dunnhumby, Nectar 360, the supermarkets, we see them strongly reflected here. And in other markets, we see more of an emerging opportunity, but partly it is also because Amazon has a lower share in those markets, such as Poland, for instance, or the Netherlands. Bottom line here is that the lower share versus the US isn't a bad thing. It shows that there is organic potential for growth in this retail media market, despite these economic headwinds. The other thing that we wanted to look at is AVOD. As I showed, the video ad market is growing strongly. We are looking at this, we have upgraded our data for this, and I think it's really clearly reflected in also other analyst data, where we can see globally AVOD is outpacing SVOD growth. We can see a 75% expansion of that market, 2022 versus 2027. And it's very different, if we look at growth in online video subscription or pay TV or traditional TV advertising, which is kind of flat. So, AVOD overtaking SVOD has already happened, and the AVOD opportunity, we believe, is extremely strong. Europe is, if we look at penetration of AVOD as share of the total market here, still lagging behind US and APAC, meaning there is more potential available here than in other markets, which again should provide an upside for that part of the market in Europe versus other parts of the world. And I'm going to close here with our updated outlook for digital ad spend in Europe in 2023, and look forward to your questions. Thank you.
Thank you so much, Daniel. Quite interesting. You said there's not really that much change since October, and then you come out with all of this additional information. So I think you've been quite modest there, especially with the agencies kept that hidden from us till the end. I've got a question. I'm going to go straight to it. Just about lower growth. You've predicted lower growth for digital in 2024 and 2025 compared to 2023. Why is this?
2025. Let's go back to the let's go back to the slide here. I haven't lowered the growth at all for 2025. We're just seeing growth moving into the single digits in 2025, as the market for digital ads is far more mature. We now have a market where digital advertising, very differently from 10 years ago, now is 60% plus of the overall ad market. This is also echoed in other agency data, and I think Magna made a very good point where they said, never before has the gap between traditional media and digital media been as narrow. And so we must expect just a narrowing of the growth and a slowing down towards single digit as digital overall is becoming far more mature. And increasingly, it might be the wrong umbrella term to use, where we need to look more specifically at different opportunities within digital to understand where is growth. It doesn't mean an end of growth for sure.
Okay, because previously you've said that 2024, you're seeing that as being the year of recovery. So actually, when we go into those single figures, this has nothing to do with the current economic climate. This is just much more, as you said, the maturity of the market.
2024 recovery, absolutely. Yes. The slowdown afterwards is an expression of the maturation of the digital ad market.
Got it. Okay. And then just another question here. Someone's asking, without retail media, would growth be flat?
It depends on how we define retail media. So it's now an it's now an 8 billion market, is 8 billion euro market. So it was in 2021, including Amazon, that is. Yeah. That is including Amazon. But the overall digital ad market is 92 billion. So even with something as large as Amazon, it wouldn't eradicate growth. If we removed all of it, would have a slower growth, I think closer to zero, can do the exact calculations, but it wouldn't remove all growth.
And then in terms of Amazon, the percentage that it accounts for the overall retail media, what would we be looking at for that?
The Amazon share of retail media, it varies by market strongly in Europe. Due to, I think, Germany and the UK being so large, on aggregate, we believe it's around 77, 78%. It's very similar to the US, but these averages obscure a much more nuanced picture, where the Amazon share is far lower in the Netherlands, the strong endemic players, and also far lower in Poland. We can see how quickly shares are shifting by, I think, the late introduction or the late expansion of Amazon in Spain, just I think two years ago or so, where previously it wasn't a really strong player, but then it ramped up very quickly. Having said that, as you saw in my charts, while we believe Amazon growth to continue, we see that the endemic retail media players in Europe are outperforming that. Partly, of course, because they are less mature. There's more organic growth from a very low level of very basic offering to something more complex, but also because it provides, number one, alternatives to Amazon, and it's also for other advertisers. If you recall, the structure of Amazon advertisers, although they're moving more into brand advertising, is very different to that of a grocery shop, where you have really much more of the brand advertisers, agency clients, etc., in that roster. And with Amazon, a large proportion is marketplace revenues from resellers and so forth. So it's a different market. And because that other part of the market is now starting a bit later, we are seeing a faster growth in that part of the channel.
So is that because you talked earlier when you were looking at retail media, you said that there's faster growth in Europe than there is compared to the US. So is that one of the reasons that it is more fragmented in Europe, that there isn't that dominant share of Amazon?
It is less mature, right? So again, a push and pull. Overall, the European market is facing more headwinds than the US, but the retail media market is at a more emerging stage right now. And this emerging stage compensates for the fact that we have economic headwinds. Also, we're seeing now, after a period of constrained inventory, we see much more inventory becoming available with a flurry of retail media launches at the tail end of 2021. Other launches, relaunches, have happened in 2023. Things are in the pipeline for next year. These are the factors that make this market grow so quickly.
Okay, and then just a question on video. So you included in video, you included CTV. What percentage does CTV account for in the video? I think you had it that it will grow by a percentage of 7.9%. What would we be looking? We always get lots of questions on CTV, and I know it's very difficult to calculate. We're still with AdX, we struggle to get those stats across the different markets. What is the share of CTV from video?
Well, yeah, we don't have a definition for Europe for CTV that is really applicable across all the markets. They're usually vendor-led definitions, and we are building that in our AdX research working group to at least from an ad spend measurement perspective to harmonize that. The proportion is still fairly low. We believe that the vast majority of spend is coming from the UK, with other markets now catching up, particularly Germany and France. But CTV is still below 10%. I don't have the exact numbers now, but it's still below 10% of the overall video figure. Will grow, but I think, as we know, there's more work to be done on measurement, on standardization. A huge opportunity, though, in particular in combination with retail media, is bringing the first-party data to further up the funnel, right? From the point of conversion, from the point of purchase away to further up in the marketing funnel. And CTV is a really compelling place to do that. And you saw, of course, Amazon already starting that with using such data in IMDb TV and others. And if we look at some of the advertisers who feed back on some of the constraints of the European CTV landscape, it is, among many other things, how can I use really exciting data for targeting? It's so easy on Amazon. How can I do that elsewhere? Yeah, I think it's a mid to long play, CTV in Europe, but despite its still moderate size, we expect it to be one of the continuous growth drivers in the next 5 years.
Brilliant. All right. Thank you, Daniel. I'm just going to share with the audience, we asked the Programmatic Trading Committee for their predictions for 2023, and the buzzwords, the privacy, innovations, but actually a lot of people saying that innovations will actually come from, they're being quite confident that they will be driven from kind of global economic uncertainty. That's actually when new ideas and things are developed, new technologies. Just if you could sum up 2023 in one sentence for us, that would be great. I always ask you this.
Yeah, it's a good question, in particular because we're in the poly crisis. There would be so many points to start from. I think 2023 is a year where cyclical and structural transformation come together to create the next generation of digital advertising businesses.
Perfect. And then in terms of that buzzword, what word do you think we're going to hear in your presentations and on every single speaking circuit next year? Is there one or two words that you think are going to dominate the chat?
I think the word headwinds has been overused economically.
Yeah.
So we're going to hear a lot of headwinds, regulatory headwinds, economic headwinds, policy headwinds, consumer headwinds. Many different winds will be blowing. The other word is probably walled gardens. We're going to hear more about that. Proprietary paths, proprietary ad ecosystems. And I think at the end of 2023, we'll also be starting about the appification of marketing and advertising. I found the AWS clean room announcement quite interesting, which illustrates, I think, that the world of ad tech and martech and the world of cloud and advertising are moving closer together, and that some advertising functions are becoming applications on the cloud.
So that, I'm sure, is going to be covered in your January top 10 trends for 2023. We can drill a bit further onto that. Okay, well, thank you so much, Daniel. Really appreciate you taking us through this. And to the audience, thank you very much for tuning in. We will be, if anyone would like a copy of Daniel's presentation, please do email me. I'm just going to put we don't give his information and his credentials out lightly. So there it is. It's mazard@ibeurope.eu, and we will pass that on. Have wonderful holidays, and we look forward to seeing you in the new year for our next State of the Nation webinar. Thank you. Bye-bye.